So, imagine this. You log into your brokerage account, right? And you see a company you're holding just reported their revenue completely free fell by like 27%.
Oh, man. That's the stuff of nightmares for a retail investor.
Right. I mean, earnings plummet by 2/3, total deliveries drop 23%. You'd think the executive team would be in full-on damage control mode.
Yeah, you'd expect a lot of sweating on the earnings call, a lot of apologies.
Exactly. But if you actually dial into the specific call, it's the exact opposite. The tone isn't defensive at all. I mean, it's practically triumphant.
They are basically taking a victory lap.
They really are.
Yeah.
Welcome to today's deep dive. We are officially putting on our Talk Tickers hats today.
My favorite hat to wear, honestly.
Same here. We're breaking down the Q2 2026 financials for KB Home. Ticker symbol is KBH.
And, the mission today is to figure out how a quarter that looks just completely disastrous on paper is actually this masterclass in corporate strategy.
Yeah, massive structural pivot. So we're translating the official earnings transcript plus the Wall Street Q&A session directly for you.
Right, because for you, the everyday retail investor, you need to know if the stock actually belongs in your portfolio or if you should run for the hills.
Yeah. Okay, so let's unpack this. We have to start with the headline numbers because you can't really analyze the strategy without acknowledging the actual damage first.
We have to rip the Band-Aid off.
We do. So the quarter ended May 31st, 2026. Revenue came in at $1.11 billion.
Which is just a massive drop.
Right. It's down 27% year over year. I mean, they were at $1.52 billion in Q2 of the previous year.
That is a severe contraction. And it bleeds right into the earnings per share, too.
Oh, absolutely. The EPS took an absolute beating. It dropped from $1.50 a year ago all the way down to 43 cents.
Wow. Yeah, 43 cents. Just a brutal haircut.
And the margins compressed, too. Gross margin dropped down to 15.2%.
And total home deliveries fell 23%. I think they only delivered, 2,395 homes?
Yep, 2,395. And the average selling price, the ASP, sat at $461,900.
Which is down 5% year over year.
Right. Though, to be fair, we should note it did tick up about 2% sequentially from the first quarter, but still. Right. In a vacuum, these are ugly. I look at these numbers and I have to play the skeptic here. To a retail investor, this looks brutal. A 27% drop in revenue. In almost any other sector, this triggers a massive panicked sell-off.
Oh, for sure.
So why aren't shareholders running for the exits? Why isn't Wall Street punishing this stock into the ground?
What's fascinating here is that Wall Street, they don't care about absolute numbers as much as they care about expectations.
Right, the guidance.
Exactly. It trades on the delta between the actual results and what was guided, and management completely telegraphed this drop.
Wait, so they basically told everyone this was going to happen?
They absolutely did. A year ago, on their Q2 2025 call, Jeff Mesker and Rob McGibney explicitly warned everybody. They said, hey, we are overhauling our entire operational chassis.
Wow. Okay. So this wasn't an accident.
Not at all. They told the street, our delivery volume is going to plummet in mid-2026 because we are making a massive transition.
So the pain was already priced in.
Completely priced in. They engineered this trough, essentially.
And the reason they sound so confident on this recent call, the victory lap we mentioned, is because these results actually exceeded the midpoint of their own internal guidance.
Yes. They didn't sink nearly as deep into that trough as they originally modeled. Wall Street is rewarding the predictability here.
Okay, that makes sense from an institutional modeling perspective. But if management deliberately throttled their own revenue, we really need to rigorously examine what they're actually pivoting to.
We have to look at the engine driving the trough.
Right. The core of this entire earnings call is their built-to-order pivot, the BTO model.
This is the whole game right here. Historically, a massive chunk of the home building industry operates on a speculative model.
The spec homes.
Right. The builder acquires the land, they pour the foundation, they frame the house, and they finish it with whatever countertops the local design team guesses will be popular.
They just guess.
They look at trends, but essentially they're guessing. They stick a sign in the yard and they just hope a buyer walks through the door who happens to love, gray vinyl plank flooring.
And white shaker cabinets.
It's always the white shaker cabinet.
But if that buyer doesn't materialize immediately, you run into the fundamental problem of real estate, right? The holding costs.
Precisely. A speculative home sitting empty on a lot, it's not just a neutral asset, it is a perishable good.
I always think about like a car dealership.
Oh, that's a good analogy.
Yeah. If a dealer has this random neon green car sitting on the lot for 4 months, they have to heavily discount it. They throw on all these margin-crushing incentives just to get rid of it.
Right, because it's just sitting there bleeding money.
Exactly. But if customer walks in and custom orders a neon green car directly from the factory, they pay full price.
Because it's exactly what they want.
Yes. There's no need to discount it. Or you could look at the spec house like a melting ice cube in a warehouse.
That is the perfect way to look at it. Every single day that spec house sits unsold, it's a melting ice cube eroding the gross margin.
Because they're paying property taxes.
Taxes, security, landscaping, utilities, and most importantly, the financing costs on all that capital tied up in the bill.
Right. And if the macro environment shifts, say mortgage rates suddenly spike, 50 basis points, foot traffic just dries up entirely.
And suddenly that melting ice cube is a massive liability. The only lever the builder has left is to aggressively slash the price.
Which brings us to KB Home's new strategy. They are trying to eliminate the ice cube entirely.
Completely get rid of it.
The transcript notes that 73% of their net orders in Q2 were built to order.
73%. That is huge.
It really is. Almost 3/4 of their entire pipeline is now initiated by a buyer who picks the lot, selects the floor plan, goes to the design studio, and locks in a contract before a single excavator touches the dirt.
It completely inverts the risk profile. By securing the buyer on the front end, they essentially establish their direct costs and their final profit margin before construction even starts.
Right, because the buyer is emotionally anchored to it now.
Emotionally and financially anchored, it's highly customized to them. It removes the need to discount the house at the end of the line.
But hold on, I have to push back on the mechanics of this for a second.
Sure, go ahead.
If 73% of their homes are customized, different floor plans, different electrical layouts, plumbing fixtures, doesn't that create just an absolute nightmare for their supply chain?
You would think so, yeah. Customization usually destroys operational efficiency.
Exactly. But the transcript shows their build times have been slashed to just 100 days.
100 days, it's wild.
That's their best cycle time in over a decade. How on earth are they doing custom homes in 100 days? That defies the basic laws of construction pacing.
It seems counterintuitive, right, until you look at how they actually structure the customization. They aren't building bespoke, one-off architectural projects.
Okay, so it's not a truly ground-up custom job.
No, it's mass customization. The underlying chassis of the house, the structural engineering, the load-bearing walls, the roof trusses, those are highly standardized.
Oh, I see.
The customization happens in the finishes, the localized selections that don't require structural reengineering.
So they are locking in the lumber package and the core framing schedule, identical to a spec builder, but allowing flexibility on the cosmetic installations.
Exactly. And hitting that 100-day build time is arguably the most critical operational metric in this entire report.
Why is that metric so crucial?
Because a 100-day cycle fundamentally alters their competitive positioning against the resale market.
Because usually, if a family needs to move for a job relocation, they can't wait 8 months for a new build.
Right. They are forced into the existing home market because they need a house now. But at just over 3 months, from dirt to keys, KB Home is suddenly a viable option for buyers on a tight timeline.
That is a massive advantage. It also gives them tremendous leverage on their working capital.
Oh, absolutely. The cash flow velocity changes entirely.
Right. Because in 2025, they were averaging 5-month build times. If you start a house in August under that old timeline, you aren't booking the revenue until January of the following year.
You missed the whole fiscal year.
But at 100 days, they can start a house deep into the late summer, deliver it, book the revenue, and satisfy Wall Street's Q4 expectations.
It's incredibly efficient, and we cannot ignore the risk mitigation aspect of that compressed timeline for the buyer, too.
Oh, right, with a volatile rate environment.
Exactly. A 100-day build means the buyer can lock in their mortgage rate much closer to the start of construction.
Which is huge when rates are bouncing around every week.
If a build takes 8 months, the buyer faces a massive risk that rates drift higher, potentially pushing their debt-to-income ratio out of bounds.
They might not even qualify for the mortgage by the time the house is finished.
Right, so a shorter cycle protects the pipeline from interest rate shocks.
Speaking of interest rate shocks and macro volatility, we really have to look at the environment they are operating in right now. Because honestly, it is far from optimal.
It's a very tough market right now.
The executive team was surprisingly candid on the call about the headwinds they faced during the spring selling season.
And spring is historically the absolute peak period for home builders.
Right. It's when everyone buys. But management cited sticky inflation, stubbornly high mortgage rates, and just general consumer malaise.
Yeah, the macro picture is messy.
They also specifically pointed to the onset of the conflict in the Middle East back in late February. They said it acted as a catalyst that froze consumer sentiment right when the spring season was supposed to kick off.
Because when people are watching geopolitical instability unfold on the news every night, taking on a $500,000 30-year liability suddenly feels incredibly daunting.
It's terrifying for the average family. But here's the interesting part. They noted that foot traffic at their communities remains strong,
which indicates the underlying demographic demand for housing is still intact. People still want to buy.
But the conversion rate from visitor to contracted buyer was heavily pressured.
Consumers were hesitant to pull the trigger.
Which raises the ultimate question for this deep dive, right? The foot traffic isn't converting because the average consumer is terrified of the macro environment. How is KB Home's BTO model actually surviving?
Right. Why are there specific buyers still signing?
Exactly. What makes their buyer resilient enough to sign a contract when everyone else is taking a step back?
The answer lies in the financial profile of the specific demographic that is attracted to a built-to-order product.
Okay, break that down for us.
This is not your marginal buyer who is stretching every single penny just to get into a starter home. When you look at the data from their joint venture, KBHS Home Loans, the metrics are staggering.
The down payment numbers really jumped out at me. The average down payment for their finance buyers is 15%.
15%, which in cash terms equates to an average of roughly $70,000 down.
70 grand in cash. That is serious liquidity for this economy.
A buyer dropping 70 grand in cash is not someone relying on an FHA zero-down program hoping for the best. They are financially fortified.
And the income numbers back that up. The average household income for these buyers sits at $136,000.
Which is well above the national median.
Their average FICO credit score is 741. And get this, roughly 8% of their Q2 deliveries were to all cash buyers.
8% bypass the mortgage market entirely. That is the protective moat around their BTO strategy.
So it's a completely different class of buyer.
Yeah, exactly. When a buyer with a 741 FICO and $70,000 of sunk equity spends weeks designing the specific finishes of their home, their psychological anchoring to that property is absolute.
They aren't going to just walk away because mortgage rates ticked up 0.25%.
No, because a buyer with $136K in household income can absorb that increase. The cancellation rates for KB Homes stay exceptionally low because these buyers are insulated from minor macro shocks.
This visibility into their buyers' financial health, it directly fuels their ability to project future performance, doesn't it?
Oh, it's the bedrock of their forward guidance.
Because the 27% revenue drop, that's the baseline. It's the bottom of the intentional trough.
Right.
But achieving that 100-day build time with these highly qualified buyers, it isn't just about making people happy today. It's the exact mechanism allowing management to project these incredibly aggressive profit margins for the remainder of 2026.
And the guidance is where the institutional money really finds its conviction. This is what Wall Street cares about.
So let's look at that guidance. For the third quarter, management expects deliveries to jump sequentially. They're projecting between 2,600 and 2,800 homes.
A very healthy jump.
Revenue is forecasted to rise to a range of $1.2 billion to $1.35 billion. But most importantly, the housing gross profit margin is expected to expand.
This is the crazy part.
From the 15.2% we saw in Q2 up to a range of 16 to 16.6%.
Projecting margin expansion of over 100 basis points in a single quarter is wild.
And for the full fiscal year 2026, they narrowed their revenue target to a very solid $4.9 billion to $5.3 billion.
But going back to those margins, doing that in an environment where lumber and material costs are experiencing localized inflation requires immense operational control.
I'm glad you brought that up because this is where I really need to challenge the assumptions built into this guidance.
Let's do it.
How exactly are they pulling a margin expansion out of thin air? If material costs are seeing upward pressure and they aren't relying on massive price hikes to the consumer because of affordability ceilings, the math just doesn't work.
Unless they are drastically cutting their direct construction costs somewhere else.
Exactly. How are they extracting those savings?
If we connect this to the bigger picture, it comes down to operational leverage against the labor market.
The labor market.
Yes. And this is perhaps the most brilliant tactical revelation from the entire transcript. Management casually noted they currently hold a backlog of over 1,500 sold homes that have not yet started construction.
Wait, 1,500 buyers with locked-in contracts and massive down payments just waiting for the permits to clear.
Precisely. That is a massive pipeline. Now, contrast that backlog with the broader macroeconomic reality of the home building sector right now.
Most builders are struggling.
High interest rates have forced a lot of KB Home's competitors to pull back drastically on housing starts. The speculative builders are hitting pause because they don't want to carry expensive inventory.
Right, the melting ice cubes.
Exactly. So the trade partners, the framing crews, the electricians, the plumbers, the concrete layers, they are suddenly looking at an incredibly soft pipeline of work.
They're terrified of having their skilled crews sit idle.
And an idle framing crew is a crew that goes to work for someone else and never comes back. Retaining skilled labor is the hardest part of being a subcontractor right now.
Oh, absolutely. So KB Home walks into the negotiation room with these trade partners holding 1,500 guaranteed pre-sold contracts.
It's the ultimate bargaining chip. They can offer a subcontractor something no one else in the market can right now. Absolute predictability.
They can look an electrician in the eye and say, we can guarantee your crews steady, even flow work every single week for the next 6 months. You won't have a single idle Tuesday.
Right. But in exchange for that guaranteed volume,
will require a structural discount on your labor rates.
You nailed it. The subcontractors are willingly sacrificing their margin per house in exchange for the volume and the security that keeps their businesses afloat.
Wow. KB Home is basically weaponizing their BTO backlog to drive down direct labor costs.
Which perfectly offsets any inflationary pressure on raw materials like lumber or copper. It protects the gross margin and makes that 16.6% Q3 guidance highly achievable.
That is a phenomenal use of operational scale. It's almost ruthlessly efficient.
It really is. But labor arbitrage isn't the only thing driving this margin expansion.
True. We have to talk about the geography. The geographic mix shift dominated the Q&A session with the analysts.
A massive amount of focus was placed on Northern California, specifically the Bay Area.
Why is this localized market acting as such an outsized catalyst for the entire company's forward guidance? I mean, it's just one region.
Because the Bay Area is one of the most supply-constrained housing markets on the planet.
The entitlement process out there is legendary.
It is a nightmare. Navigating the environmental reviews, the local zoning boards, the community pushback, it is a bureaucratic labyrinth that takes years, sometimes a decade to clear.
Which creates an artificial scarcity of new construction.
Exactly. And that scarcity drives the average selling price, the ASP, to astronomical levels.
But KB Home's management was very transparent on the call, admitting that their Bay Area division had actually been struggling for several years.
Yeah, they suffered from management turnover, they lost momentum on land deals, and their volume in that region eroded significantly.
They didn't even mention it on prior calls because they felt it would sound like making excuses. Jeff Mesker, the executive chairman, was surprisingly blunt about that.
Admitting failure on a localized team level in front of Wall Street analysts takes a level of candor you rarely see.
But the narrative has shifted now.
Completely. They quietly rebuilt that divisional team. They patiently pushed a specific portfolio of communities through that grueling entitlement process. And now those high-margin communities are finally coming online for active selling.
And the math on the overall corporate margin is heavily skewed by these openings, isn't it?
Unbelievably skewed. Bill Hollinger, the chief accounting officer, projected that by the fourth quarter, the company-wide average selling price will approach $500,000.
$500,000 average.
And he explicitly attributed that aggressive upward trajectory to this favorable mix shift toward the West Coast.
I mean, if you sell a house in Texas for $350,000 at a 15% margin, that's a solid single hit.
It pays the bills.
But if you sell a house in San Jose for $1.2 million at a 22% margin, the sheer dollar volume of that gross profit drags the entire corporate average upward.
A handful of successful communities in the North Bay completely recalibrates the margin profile of the overall balance sheet.
Analysts from Barclays and UBS were pressing them hard on this during the Q&A too.
Yeah.
They wanted to know if this Bay Area mixed benefit was just a temporary blip, like a Q4 anomaly.
And management pushed back aggressively on that. They stated that their land pipeline in Northern California is structured to provide a sustainable multi-year tailwind stretching well into fiscal 2027 and beyond.
It demonstrates a real return to dominance in a market with exceptionally high barriers to entry.
And they are using that same calculated approach to capital deployment to plant flags in entirely new territories now.
Right. The official announcement of their expansion into the Atlanta market, that is a massive signal of balance sheet confidence.
It's a huge move.
They just acquired their first land parcel in Atlanta, with the community expected to open for sales in early 2027. Now, Atlanta is a top 10 housing market nationally.
It has massive Sunbelt migration tailwinds, immense job growth, and a relatively favorable regulatory environment compared to the West Coast.
But it is also intensely competitive. Every major national builder is already entrenched in Atlanta.
It's crowded.
The analysts from Wolf Research specifically asked them why they're choosing to enter such a saturated market now and how long it will actually take to achieve any meaningful scale.
And management's response was to point directly to their own recent historical precedent.
The Seattle and Boise playbook.
Exactly. A few years ago, they entered Seattle and Boise from an absolute standstill. Today, those two markets are projected to represent roughly 10% of their total corporate volume in fiscal 2026.
So they proved they have a scalable blueprint for market entry. And they aren't starting from scratch in Atlanta when it comes to the human capital required to execute that blueprint.
That is the critical detail here. In home building, the company that controls the best entitled land wins.
And you don't acquire premium land by browsing public listings on the internet.
No, you acquire it through deep, localized, off-market relationships with land sellers and local municipalities.
So by hiring a division president in Atlanta who brings 25 years of established local relationships, KB Home is essentially porting over decades of networking equity.
They use that to jumpstart their land acquisition pipeline. They are buying the network, not just the dirt.
Buying the network. That accelerates the timeline to profitability in that new division exponentially.
Absolutely.
Okay, so we have mapped the mechanics. We understand the BTO pivot, the operational leverage against the subcontractors, the high-margin California tailwinds, and the Atlanta expansion.
We've covered a lot of ground.
We have. Which brings us to the ultimate verdict for you. The retail investor holding or evaluating this stock. It is time to look at the bottom line.
The moment of truth.
Taking everything we've analyzed from this Q2 transcript, what is the official talk ticker stance? Are we fundamentally bullish or bearish on KB Home's long-term prospects?
Analyzing the raw mechanics of their strategy and their balance sheet, I am taking a firmly, cautiously bullish stance.
Cautiously bullish. Okay, why the caution?
The caution is mandatory because no builder is entirely immune to macroeconomic gravity. If mortgage rates suddenly spike to 9% tomorrow, the entire sector will seize up.
Regardless of how strong a BTO backlog is.
Exactly. But for the patient, long-term investor who can look past the 27% revenue drop on the headline, the underlying structural health of this company is exceptionally strong.
And the most compelling piece of evidence for that bullish stance isn't found in their forward guidance or their build times. It is found in how management deploy their excess capital during the quarter.
Oh, the share repurchase activity in Q2 is the definitive signal for the retail investor.
They aggressively bought back 1.4 million shares of their own common stock,
deploying $75 million in capital to do it.
But the absolute volume of the buyback isn't even what matters most. It is the arbitrage opportunity they recognized in their own valuation.
Jeff Mesker pointed out that the average purchase price for those 1.4 million shares was significantly below the company's book value.
And that is the crux of the investment thesis right there. The transcript revealed that their book value per share expanded nearly $62.
Which means the net unencumbered value of their hard assets, the entitled land, the construction equipment, the physical structures, minus all liabilities, is worth $62 per share.
Yet the stock was trading on the open market at a substantial discount to that number.
The broader market, fixated on the headline revenue drop, was essentially valuing the ongoing profitable business operations of KB Home at less than the liquidation value of their raw dirt.
It is a massive market inefficiency. Wall Street basically got it wrong.
And management ruthlessly exploited it. When an executive team takes $75 million in cash and buys their own stock below book value, they are executing the most accretive, risk-free capital allocation possible.
It instantaneously increases the earnings per share and the fundamental book value for every single investor who holds onto their shares.
They are screaming to the market, "You are mispricing our assets, and we will happily take that equity back."
And they are signaling that the buybacks will continue too. They have $775 million remaining under the board's current authorization.
And they explicitly forecasted repurchasing another $50 million to $100 million in the third quarter alone.
Add in the $15 million they distributed in dividends, which yields about 2% annualized, and you have a management team that is actively returning massive amounts of capital to shareholders.
While simultaneously funding a nationwide geographic expansion, it's incredibly impressive.
So what does this all mean? For the retail investor, the narrative is pretty clear. KB Home has successfully completed a highly complex, highly painful transition from a high-risk speculative builder to a low-risk, high-visibility built-to-order manufacturer.
The 27% revenue drop was just the calculated cost of admission for a much safer, more predictable margin profile going forward.
If you hold the stock, the strategy requires you to stomach the short-term noise of fluctuating mortgage rates and focus on the execution of that 1,500 home backlog.
The foundation is rock solid, and management is completely aligned with shareholder value through aggressive, mathematically sound capital allocation.
It is a textbook example of why the headline numbers never tell the full story, which perfectly encapsulates the mission of this deep dive.
Absolutely.
But as we wrap up our analysis of KB Home today, I want to pivot away from the balance sheet for a moment. I want to look at the broader implications of this BTO strategy for the entire housing ecosystem.
Okay, let's zoom out.
Because if this model is as structurally superior as it appears, it raises a profound macroeconomic question for you to consider.
Let's hear it.
We've just spent an hour detailing how KB Home's built-to-order model aggressively insulates them from market downturns, locking in highly capitalized buyers with $70,000 down payments before a shovel hits the dirt, virtually eliminates holding costs and margin erosion.
Right. It's the ultimate risk mitigation.
But if this mathematically proven efficiency becomes the gold standard for maintaining profitability, and institutional investors start demanding this level of risk mitigation from every publicly traded builder,
will we eventually see the entire home building industry abandon speculative building altogether?
That is the staggering proposition.
It really is.
And if the industry universally stops building spec homes, what happens to the liquidity of the housing market? What happens to the everyday family who gets a sudden job relocation across the country and needs to buy a move-in-ready house on 30 days' notice?
They'd be completely stuck.
If the only way to get new construction is to sign a contract and wait a minimum of 100 days for a custom build, does the concept of instant gratification in the new home market completely vanish?
It would fundamentally alter the mobility of the American workforce.
Do we enter an era where housing inventory is so tightly controlled by corporate risk mitigation that the consumer loses all flexibility?
If you can't buy a house when you need it, you can't move. The ripple effects on the broader economy would be immense.
It's an outcome worth watching closely as more builders try to replicate the exact efficiencies we've unpacked today. We started this deep dive looking at a 27% revenue drop, expecting a story of corporate distress.
Instead, we found a company actively redefining its own operational physics,
trading top-line vanity metrics for structural resilience and margin control. Keep that mechanism in mind the next time a headline tries to tell you exactly how to feel about an earnings report. Look past the drop, find the trough, and ask what they are building on the other side. Till next time.